Today I brought another video, or you can call it as a lecture, where I would like to discuss how you actually design your portfolio, or other way, how you measure your portfolio risk. So what does it mean by the portfolio part? Before that, I have some disclaimer. What is a portfolio, right? The portfolio is simply everything you own, investment grouped together. So in this picture, if you look, you will be seeing that what kind of portfolio Mr. Buffett owns it. I'm not going to talk about Mr. Buffett portfolio here, but how a example of a portfolio looks like. So that is given here. Next thing about what is the risk? So you build a portfolio, or you buy some share, buy some bond, you buy some stocks there, but it comes with the risk out there. So what are the risk? So it might possible that risk is in investing in any chance that you don't get return as you expected. That is basically the risk. So now you think about that, you put money in a government bond, how much you got back? So expected return is 3%. So it's a very low amount of risk you are taking. Then option B is you're investing on technology stocks. Your expected return is 10%. It could go 30% up, 20% down. High risk portfolio here, or high risk stocks here. And obviously the uncertainty is high. Next thing is basically how you measure the risk, which is basically nothing but the beta. It's an indicator. I'm not going to discuss that much about what is a beta is here. What I'm going to discuss mostly about is how you can interpret the beta and where you can find a beta for your portfolio. And also, I'll give it to you an Excel sheet that will help you to calculate your own personal portfolio. In this video, stay tuned. I'll show you how you can do it. So think about the beta if it is 1, so you are going with the market. So market, what does it mean is the market. Market is nothing but if you're following S&P 500, so like top 500 companies in the US, or TSX in Toronto, or Nifty 50 in India. So if your stocks beta is 1, or your portfolio beta is 1, so basically you're going with the market. So market, if tomorrow gets 10% return in S&P 500, you'll be getting a 10% return. Let's dive into more details, how you interpreted the beta and what is the meaning of that. So here is the table. We have the beta and the meaning, and then expected if the market goes up 10% of the example, just example. So it is 0.5 of the beta, which is less risky than market. So if the investment goes up, like the market goes up 10%, your investment will go up only 5% because your beta is 0.5. One, same risk as a market. So if your investment goes up 10%, sorry, your market goes up 10%, so your investment will go up 10%. The vice versa true. So if it is market goes 10% down, you are 10% down there. 1.5 more risky than market. So if market makes 10%, you make 15%, but the vice versa also true. If market make 10%, lose 10%, you might lose 10% here. 0, no market relationship, which is the treasury bill. It doesn't matter, or bond. It doesn't matter in this case, that whatever the market makes, you will get a fixed income always. So 2 to 3% in Canada, sometimes a little bit more based on a treasury bill, but nothing like a huge amount of market you can capture from there. The last point is basically negative beta. So moves opposite to the market. It's very rare. We'll not talk about that. But now if you think about where we can get the beta and how we'll calculate. So for each of the stocks or bond, you can go to these Yahoo Finance. So you go to the link Yahoo Finance here, and you paste it in your browser. You find out, you open there. So you go there, you pick any of these stocks over here. So let's take it at Oracle. So what you are looking at here, all the important factors are there, but there is a beta. It's written here, like 5-year monthly beta is 1.65. So what does it mean is 1.65. It's actually high, and it has a high uncertainty also written. So what does it mean is if the market makes $1, you might make $1.65, but also the vice versa is true. If market lose $1, you will be losing $1.65 from your portfolio. So this is basically each of the stock, or like the individual stock portfolio beta. But what I'm going to show you in my Excel sheet, that will be calculating your overall portfolio or beta, which is basically it could be a stock, bonds, but you need to have just give the information and it will calculate for you. Let me introduce to my Excel sheet here. So before I go to the deep dive into the Excel sheet, there are a couple of terms I would like to introduce and explain to you what does it mean by that particular terms, and that will be using in an Excel sheet. This is something called risk-free rate. So risk-free rate is basically you give your money to the investment and you know that you'll be getting a particularly a money back after a certain time period. Sometimes we call it as a fixed deposit, which might have a certain portion of income there, or investment in the bond, government bond. Basically, it's a very safe returns. So you give the money, it might have 3% returns on each year, so they will give you money. And in Canada, sometimes it's called GIC too, guaranteed income. Guaranteed income. Expected market returns. The average returns investor expect from an overall stock market. So, which is if you follow the S&P 500 over the long run, then how much you get it. So that's basically market return. And then there's a market risk premium. So what does it mean is basically if you're taking a risk, extra return investor are expecting that. So how much the worth of the risk you're taking on that. The just a simple formula is market return minus your risk rate is basically your premium, market risk premium. We talked about the beta before, but here just in simple term is if it is a 1, moves with the market. If it is greater than 1, more volatile than the market, you get more return, but there are possibility that you might get lose money actually. And beta is equal to less than 1, less volatile than the market, but you aren't lesser than that. Now the CAPM is another indicator or the calculation. Expected return is the return of your portfolio, how much you are getting and what the risk level you are looking for. It's answered that am I being adequately compensated for the risk I'm taking? So basically you are taking a risk and is it worth to take that risk or not? That is the formula is there. I'm not going to discuss about the formula. I'm going to show you actually how it's look like in the calculator that's I built here. And so I move this one here and I'm going to talk about the calculator. So there are a couple of assumption or input you have to put it here, which is basically risk-free rate, which is 3%, which is basically if you don't go with all this portfolio anywhere, if you just invest $100 in this particularly risk-free rate, end of the year, you'll be getting $3 back and so on. Expected market rate of the return, which is basically suppose the TSX or S&P 500, the bigger indicator, they are giving you return like 9%. So each year, if you just follow them, you should get 9% return there. And market risk premium, as we talked about, that if you deduct expected market return to risk-free rate, you get market risk premium, which is the formula here, right? So now we have to calculate the overall portfolio, how the portfolio beta is there. Don't come to the portfolio beta, how it's coming. You can see it here is the sum of the G, which is basically the weighted value here. Let's put it there. But first we talk about that where we are investing. So these are the bunch of company in Canada I picked up. We're investing here, like a couple of banks, top banks. Then Brookfield Corporation, CIBC, another bank, Canadian Pacific Kansas City, which is basically a railroading company, Enbridge. Manulife is Enbridge is basically oil and gas infrastructure company. Manulife is a insurance company. You keep some gas, and then energy sector, TC Energy there. So it's ticker there. So at the beginning, let's think about that. We just have $1,000 and we keep $100 in each of these, right? And these beta I showed you before from the Yahoo Finance, you can copy paste it here. Obviously, these beta actually changes with the time. So you have to remember that. So you can see that the Royal Bank has beta 0.94, 0.88. Also, another thing is this beta could change tomorrow. It doesn't matter. It at the moment when I picked it up, it was like that. So anyway, Royal Bank 0.94 or 0.28 for TD Bank. It doesn't mean it's a little less volatile than the market, but what the BMO is actually a little bit more than the market there, where Brookfield Corporation is also really little really higher portion there. Also, you can see that there are cash, so you're just keeping cash in your hand for some emergency reason, so just keep it there, right? TC energy almost perfect, so if it is almost perfect, I'll say like 0.977. So if the market moves on, you'll be getting 97 cents. So like if the market makes $1, you'll be getting 97 cents out of it, right? Then in your portfolio, this calculation, you can say yes or no. So you can just type no. Then it will not include there that particularly stock, or if you want to include that, that will be yes. So then it will include there. The weight is basically, it's based on, you can see the investment, how you are putting there. So if you are investing some money and if you're including, then the weight will be calculated there, right? And the weighted beta is nothing but that how much the beta is there, and if it is included, then it will be calculated, and what is the weight there. So that will be calculated there. And the CAPM for particularly this one is basically if you're including how much risk premium you're getting from there. So overall, you can see is that you have total investment $1,000, your portfolio is 0.99. So it's very nicely designed that if the market moves $1, you'll be getting $0.99, and your portfolio return is 8.93% there. As you can think about that, it's 0.99 or it's almost closer to 1. So you can think like, so basically you're supposed to get how the market moves, almost the same as there. So if the market moves 9%, almost you should get really closer to that. So 8.9 is almost closer to that, which is the portfolio there. But now the interesting fact, how about these are the mostly not that much of a volatile stock, like a tech stock. So if I add something tech stock, which is like, let's put as a Microsoft, right? Microsoft, I have to go and Google over here, right? So now I have to go and find it out. Yo, finance, Microsoft, and Microsoft. We can like, let's put Microsoft TO. Then we know that this is a Canadian part, not the US part. So yes, so we have Microsoft Toronto, which is lower, but monthly beta is 1.1. This is Canadian version of it. So let's go back to the Excel sheet. Here, and I put both of them 100, t.to. And then again, I'll do the same thing for Google actually. So it's Alphabet parent company, and it has 1.2. So you see, okay, so I put it there. It's still not calculating because I did not include. The moment I said yes, so you can see that my portfolio beta is now going up like 1. Now I'm supposed to get 1 portfolio. Like it's basically it's going with the market. That's it. Then I add these. My portfolio is little up than more than market. So my portfolio beta is 1.02 and my CAPM is 9.11. So you can see how things is moving. One thing is very interesting. Instead of $100, if you make it 200, then you see you are getting more money out of it. So 1.02, then again it's 200. See, these are the things is going up substantially. If you want to put 2000, then you can have really up like 1.16. So you are taking more risk for the market, and your weight of the portfolio is here. So you put more money, and then you have a high risk, so you will be high return eventually. So that is about it. So if you want to design something like more like a balanced in this way, you can put $1,000 here, $1,000 here. And then you can see this is almost coming near around your portfolio is 1, but still I'll say little higher than 1. Obviously, if you want to take the risk, which is fine, based on how your risk appetite is, that's basically it. And I put some instruction here how you can change a particular area, what are the steps are there, where you go to the location and how get it there, how you can extract the data. So whenever you have this Excel sheet, you can do it. This is basically a Excel handy, you can use it. Only the thing is, if you think like your portfolio is going up more, so when you are adding something, then you might have to say yes and no, and basically you have to drag these formulas over there. So those who are good with Excel, I believe they can use this one. So thank you. See you in the next video. Probably I'll be building something in a Python. Those who are more like a coding person, they can use it in the same component, but it'll be less manual. It's more like a directly will take out the data from the year finance. Thank you.